Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. If this is your first time, we're not normally at this angle, but one of the computers is giving problems in the Dragon capsule. Luckily, the astronauts came down okay, but we are here and we're ready to go. So without further ado, let's get with it. So if you haven't been with us before, there's this disclaimer that we have to go through. If you've seen any of our videos, you know that this is a part of the process. And basically, if you haven't seen it, take a screenshot of it, read it in detail in your leisure. However, a couple of things that the powers that be want us to make you aware of. Number one, we are not registered to give individual investment advice in the United States. And two, because we have a lot of international viewers, we have a lot of international subscribers, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. So again, take a screenshot of it, read it in detail in your leisure. So how does TradeFinder work? Well, we're going to talk a little bit about the market, and pretty interesting. If you watched my last SPY update on YouTube, interesting day today, kind of right along the theme of what I was talking about. We'll get into that. And then from there, we'll do a review of any case studies that we may have closed for our subscribers. So those would be alerts for our alert subscribers to give you an idea of how that works. Then we'll do a review of past TradeFinder case study considerations, things that we've identified during previous TradeFinder broadcasts that you can follow along with yourself. And then when that's finished, we'll look for one of our own this evening. And with whatever time is left, we'll do a little Q&A and see if we can look at some of your favorite stock symbols. That's what the Q&A usually amounts to. We do have support on if you have any administrative questions, but other than that, at the end, usually it's people firing out their favorite stock symbol, and then we take a look to see what our indicators show on those. So that's it. That's how TradeFinder works. So let's go ahead and get into it. Taking a look at the market itself. For those of you that may be brand new, this is a program called Profitsource. It's developed by the Hub organization, and it is, in my opinion, the best Elliott Wave software program that exists. Been trading Elliott Wave for 20 years. I believe I've tried all the Elliott Wave programs. At least I've tried all the ones that I think exist, and this is the best. People like it. The screen's nice and sharp. It's clean. It's easy to see. You have all the tools to move things around, measure, create your own searches. It's a really great program. So in the last SPY update, we talked about how last week there had been 5 dojis. I don't know if I can ever remember that. I've been trying to think about it, and I've been trading Elliott Wave for 20 years, but I've been trading for 25 years. And I can't remember when there was a week, Monday through Friday, where every day was a doji. And I know I used the word doji in a generalized form, because if I spread this out a bit for you, you can see that over those 5 days, there were different formations. Now, a perfect doji is when the open and the close, so that would be an example of the 16, are the exact same price. But when you look at the definition of a doji, which I went through in the last SPY update, it is if the open and close are similar, virtually similar, about the same. Those are the definitions that you get. So it doesn't have to be exactly the same, but there's different sizes. Like this little plus sign, that's a regular or standard doji. And then when you have one like this is a dragonfly, where you have this big long base here. So there's different kinds, and then you get into different patterns with spinning tops, etc. But the bottom line is the fact that when you have an open and a close that are similar, and then you have the body where you have your high and low of the day, it promotes indecision. The market doesn't know what to do. Well, here we bounced off of that. We hit our 420 level. If you are fairly new with us and you haven't watched some of our previous videos, please go back and look, because going all the way back down to here, June of last year, when we started this C wave extension here, I'll just go ahead and condense this now. See, it's pretty cool. I mean, if you condense it, you can spread it out. If you want to see more data, if you want to take some away, you have all this information right in front of you. And so here is that zigzag pattern that we're talking about with the 161.8% extended C wave. And that was concerning to me because in the 25 years, I can only remember a handful of times where a market, not a stock, but a market extended to the 261.8% level, which would be the next level if we move higher from here without some sort of a correction. So we hit the 420 level, so we nailed that. So again, go back and watch. You can see our videos over the previous months where we were calling for that level. We hit it. We actually touched it with this doji here on the 29th. So that was a resistance level. So we hit that resistance level and we moved down today, and lo and behold, there's another doji time. We opened at 416.07. We closed at 415.62. Was it at the exact open and close? No. Are they similar? I think so. They're pretty similar, and it looks kind of like that same bar on the 29th. So a bit of a dragonfly again here. So it's just the market is unsure right now. And so what I talked about in the last SPY update, if you didn't look at it, was the fact that prudence would say we need to protect ourselves to the downside. And we've done that. We have SPY puts for our subscribers. We have calls on the SQQQ, which actually goes up in value if the NASDAQ goes down. So it was up today. It's just the market is really, really unsure right now. Anything could happen. And this is one of those times where you have to just let the market tell you. If you're putting on trades right now, in my opinion, you're guessing. Let the market tell you where the next move is, because the next move is going to be pretty significant. In other words, we're going to break from here and go up to that 261.8% level, or we're going to break down and likely come down and test that 100% extension down around 381. We still have this gap here that hasn't been filled down at 400. So that would be the absolute first stop. And then we gap down today. So there's a lot of things that need to happen. So this is one of those times where you need to let the Elliott Wave pattern reset up and give you guidance. Now, if you just want to be the wild, wild west and just go flaming and shooting at things, then do that. Go ahead. But know that you're guessing, at least from an Elliott Wave standpoint, on where the market goes from here. The market will tell us. And when it breaks one direction, we need a follow-through day. Now, even though we did finish back near the highs of the day, so it's odd, right? It's a down day, but kind of a bullish down day. So we had a move to the downside, but yet we finished near the high of the day, recovering the lows. So that would be viewed as a positive. So maybe that was just a bit of an aberration, a head fake, if you will, which is why we need a second or confirmation day. That's what I'm getting at, is if we get a confirmation day to the downside here from today, well, then we can be pretty confident we're going to fill that gap and likely come down and test this 100% fib extension. Even that doesn't mean that it precludes going higher. So if you still have a view that with the Fed liquidity, we can go higher, then even coming all the way back down to 381 doesn't stop that from happening. My concern, and this has been chatter back and forth with some comments on my YouTube video, is, well, the Federal Reserve is still injecting all that liquidity. Are they? Or are they just telling us they are, and they're trying to engineer a soft landing rather than, because if they came out, they've been telling us they're not going to raise rates this year and probably not next year, maybe towards the end of next year, but then we get a 6% print on the GDP. Are they telling us one thing and doing another? They've done that before. The Federal Reserve has done that before. So am I saying I don't trust them? Yeah, I am. I'm saying I don't trust what they're saying. And so we need to just be smart and protect ourselves either direction. If we have a short-term loss here, it's been a sideways kind of time frame here since going back to mid-April. Well, you accept those as a bit of a drawdown, knowing that there's better things to come, but it's better than getting wiped out. So when you look here, and then we put the 10-day moving average, you can see that that's not, even though the bar would kind of be viewed as a bullish bar, the fact that the high was the 10-day moving average and we still closed below it, if it was going to be a bit more bullish, we could have closed back above that 10-day moving average. But with all that said, And hopefully you got the point in the middle of this is that we need a second day or a follow-through day. Today doesn't mean anything, really. I mean, in the grand scheme of things, today's meaningless. Tomorrow now matters. If we close lower tomorrow, okay, we have an idea where we're going and we can look to set up some downside trades. And we've got a whole bunch of them ready to go for our alert subscribers. We've had them ready to go since back here in March. And so we'll start to enact some of those that have big vacuum gaps of where they can drop before they hit support. Not all of our positions are shortable, if you will. Some of them have had stair steps up. Those aren't the ones that you look for in a downward move. What you look for is the ones that went kind of vertically up or almost vertically up, and then they don't have any support for a while. So there's a big vacuum and you can get a significant drop, even if this is just a shorter term correction. But as far as today, we could trade back to the upside tomorrow, close that gap, be back above the 10-day moving average, and then that just completely wipes out what happened today. Head fakes occur all the time. That's why I say that you need to have a second day, a follow through, a confirmation day. That's one of my rules. If you've listened to me in the past, you know you're probably starting to pick some of them up. Second day, confirmation, follow through day. No security in any time frame gets very far away from the 10-day moving average. Gaps get filled. Those are rules because they happen in a very high percentage of the time. So when you have something, nothing's 100%, but when you have something that's in the 90 percentile, like those rules are, those become hardcore rules that you follow along with your trading. So there's not a whole lot else to say regarding where we are with the market. So that whole doji fest, I called it, that we had last week, and then we start off and we touched 420 again, 419.84 on the high yesterday, and then today gap down, and we're below the 10-day moving average. Notice back here on these days, pretty good intraday volatility that occurred here each day, tapping the 10-day moving average, but closing above it as we moved up to 420. Today we did the opposite. We traded below the 10-day moving average. We tapped it on the high. So again, we have to be very careful to see. Now the futures at this moment are up. Long time between now and when the market opens. That's another thing. I'm going to do another video. Watch for this on YouTube. I've noticed this. I've made comments about it, but then I also saw some data over the weekend that confirmed it, where over this past year, the majority of the move that happens intraday is occurring overnight. The futures market is usually a gauge of telling you where the actual market's going to open. That's been kind of its MO. That's what it does. But lately, it's been like that's the move that occurs. So there is some big money that's now trading in the futures market overnight. Really, really interesting. So I'm going to go into detail on that so you can start to think about things like that. And we're going to talk more about that, as I said in the video. So watch for that because it's fascinating. It's my favorite word. A lot of our subscribers like to give me a hard time because they use the word fascinating a lot, but I am fascinated by the market. So won't label me that. That's fine. But so here's the 420. That's the gap down and trading back up to the 10-day moving average. Dragonfly doji. What happens tomorrow? Nobody knows. We'll wait and see. Now the key is what happens after we close that gap, because if the futures hold, we'll close that gap on the open, and then what happens? Can we hold it? Can we trade back above the 10-day moving average? Or do we close the gap and then trade lower? Now that's going to be an interesting day, isn't it? Think about this for a second. What if we open higher, fill this gap, we trade lower on the day, but we don't trade below the low of today? Does that count as a follow-through day? It does. If we close lower tomorrow, even if we move up and fill the gap and we close lower tomorrow than where we closed today, even if we don't take out the low of today, it still counts as a follow-through day. So that's, I just wanted to share that with you if you're wondering, okay, now how do we know what's going on tomorrow? That's it. All right, so that's the market. That's where we sit at the close today. Just makes tomorrow a super, super interesting day. All right, so I did want to share with you a case study that we closed. We actually did this for both our portfolios. We did it for our volatility strategy portfolio, and we did some different strikes because in the volatility strategy, we're doing strangles. It's our, I still like to call it proprietary, even though there's been some, there was a publisher that contacted me about writing a book about this strategy because they felt like it was something new and different. They encouraged me to be careful about using that word. I've yet to find anybody that does it exactly the way we do it. Maybe there is somebody out there, but basically we follow the delta curve. And we've got a new educational series coming up called Strangle Mastery. This is going to come up towards the middle end of May. And the Strangle Mastery class is going to have a heavy focus on options with the pricing, delta and gamma going in there, along with talking about the triangle patterns and how we set up the strangles, etc. But you'll see in detail why we set them up the way we do. And the way we do it is that you're then mathematically guaranteed, if the stock moves, because there's no guarantee the stock's going to move, it has to move for the strategy to work. For the option that's going up the delta curve in the direction the stock is moving, is making money as fast as mathematically possible, and the one going the opposite direction is losing money as slow as mathematically possible, because in a strangle, you've got a long call and a long put. So you've got both sides covered. One's making money, one's losing money. So we want to set it up to where the one that's making money is making it as fast as possible, and the one that's losing money is losing it as slow as possible. Makes sense, right? So we're going to go into more detail on how the option pricing and the Greeks work along those lines. Now you can see this, and I'm going to show you this mark-to-market graph that we do, because this isn't normally how it works. You can see here that basically from day one on the entry, there's the zero line, the position started moving and making money until it got to the point where we closed it out today. Why am I saying it doesn't usually work that way? Well, we're buying a call and we're buying a put. So time decay becomes a significant enemy. If the stock doesn't begin to move immediately, the very next day, the position will show a loss. And that's because time decay comes out of both the call and the put. So normally this position will spend a fair amount of time in the negative underneath the zero line until the breakout occurs. And then you get this move, as you see here, where it starts to go vertically up when you get the significant breakout. But this one started moving right after we put the position on. And fortunately, we had this in our volatility strategy, and we also had it in our high value portfolio where we put the strikes just slightly less out of the money. So we covered both ends of where our sweet spot is. There's an area there on the delta from 25 to 25. I don't like to go too much below 25. I don't like to go too much above. And I don't like to go above 35 at all. But we could cover both sides of that with the different strikes. Both of them returned over 30%, which is the lower end of our breakout percentage in 11 days. That's shorter. Normally, it's around 30-day average on these triangles to break out to hit our profit target, which is 30 to 70%. But FSLY reports earnings after the close tomorrow. So we had a break to the downside. Now, if we held this position, we could have reset the deltas and tried to hold it, but then you're also going to get a big IV dump following the earnings report. So we had a break to the downside, and with the break to the downside and the position setting up for a nice profit with the IV holding into earnings, it made sense to go ahead and close the position out. So here was the chart. That's what it looked like right here. You can see that there were gaps higher. So had it broken to the upside, some significant move to the upside. We did have some support down here around 50. So there was big potential movement here, but then we have the earnings report on the horizon. Now, this is what I thought was going to happen. So it's, often when you think what's going to happen, you're wrong and you lose money. In this case, what I thought was going to happen didn't happen, but we were still able to generate a gain. So what I thought was going to happen was we were going to go sideways for a while longer into the earnings report. So I thought we would just churn here, continue to churn, right, and fill this triangle towards the point into earnings, then break out. Then we had, big move, room to the upside, big room movement to the downside. So we had support down there below 50, and we got gaps of about just below 90, and then another one below 110. But the stock didn't want to do that. It didn't want to stay sideways. It started breaking out right away. So with that in mind, knowing that the earnings report is coming, since it broke to the downside, had we not taken the position off today, then we would have, and here I'll show it to you today, had we not taken it off, you know how Murphy's Law works. It broke to the downside, so likely when the earnings comes out tomorrow, it would have recovered and broken back to the upside. And had it done that, see, here's what happened. There we go. There's your downside breakout from the triangle. And this will be one, the earnings report comes out and they go rocketing back to the upside. And so then all the profit's gone, volatility's gone. Now you got to sit and wait for that significant move. And if it moves to the upside, okay, well, if we go up here and fill that gap, then we'd be okay. But how long does it take to get there? You might get an upward break, come in and fill this gap right there, and then take its time. And that would not have been a good scenario. So the fact that it broke out before earnings, the IV's still in there, even though there was more potential room for the breakout movement, there are times when, hey, just be happy, made over 30% on 2 different positions on the same pattern within 11 days, you take that. So shorter term, lower end of the profit range, we're okay with that. We'll take that and be happy and move on. So that's one I wanted to share with you. And that's the kind of thought process that goes into the alerts that are sent out. Again, in a TradeFinder, when we do case study identifications, we give you, okay, well, here's a pattern that looks bullish or bearish, and then you're on your own as far as how you handle it from there. Our alert subscription, we send out entry alerts, we send out any adjustments during the time frame, and we send out exit alerts as well. So we help guide you on, and you don't have to follow them. It's still your account. You're still in control of your own money. It's just a guideline to follow if you'd like to, or you can do your own thing. So we have subscribers that have taken our education and they've worked that into their own trading system. So we do a lot of education at Elliott Wave Options as well, because our goal is not just to be an alert service. We want to be an educational service that does alerts. There's a lot of services out there that they only do alerts and that's it. That's not our goal. Our goal is to try to educate people on the aspects and the great things about Elliott Wave so that you can incorporate it into your own trading. And at some point in time, you're trading on your own. You don't need guidance from the alerts. There are some people that are like, well, I don't really want to learn that. I just prefer to follow along with the alerts. The track record's been good over a number of years, so I'll just follow along with that. That's fine too, whatever your motivation. But we want to cover all bases. We just don't want to be one. We don't want to be, just one aspect of the world of trading. All right, so let's go back and take a look at some of our previous case studies. We closed down a lot of them over the past couple of weeks. We looked at AOS, which we turned into a strangle. Show you that. So here's the breakout, so you can see what's coming there. Move this out of the way here. So we move this back to the 16th. There was the entry, and then I'll move this forward, and you can see why we moved it into a strangle. See that triangle here? You're starting to see the formation of a triangle. So we talked about, well, let's just go ahead and turn this into a strangle. You're already moving to the upside, and there we go. We've continued to break higher. So we had already broken to the upside. We did protect the downside here just to be safe, but we've broken higher. So I think we can go ahead and close this one out too and say this one's done as well. And that was the oldest one that we had. So now we're all the way up to case study considerations that we found on April 6th. So we'll look at SWK, Stanley Black and Decker. And we looked at this one on the 6th. So here's where we were. Wave 3, movement to the upside. At the time, you can see we had a DMI that was supportive of a continued move higher. So we were trading at 203.97. Now we're at 210. So we moved up 7 points. There's another of those dojis. That's more of the tombstone, which is the opposite of the dragonfly, where you have the open and close up near the top. Now you have the open and close down near the bottom. That's not exactly what you're looking for as far as a continued move higher, but it still does show indecision. That's the bottom line of what a doji shows. So 7 points to the upside, is that enough? We'll keep it going just to see what happens as far as monitoring it here. And you have to decide, at what point would you take profits, etc. CNTY was another one that we had moved into a strangle. Now this one looks to also break to the upside. So we looked at this on the 16th. So here we are. So here was our strangle. And boom, there's the breakout. And so we went from 11 to 13. The mouth of the triangle is from 9. It looks like we have a little more to go here on the breakout. So if you didn't close it out on the 29th or even here on the 30th, which would have been Friday, you could see we tapped the 10-day moving average on the low. You could look to hold this and see if we get a little bit more movement to the upside, but perhaps Friday would have been a better exit there with that nice move higher. But we've been waiting for that one to move, and it did. So let's look at TWI. Titan International also was on the 6th. There's our setup, and continue to move to the upside. So some of these are in our momentum search. We're looking for these lower dollar stocks, continue to move. So going back, we were at 10.19, and now we're at 11.25. So basically it's moved $1. And there's another doji, looks exactly like the market. I mean, there's this indecision everywhere. Not just in the SPY, but on all these different positions. You can see the market doesn't know what's going on right now. So when the market is this indecisive, it's prudent to protect both sides. So it's broken higher, but you have to see from there. Then the following week, we looked at SKM. I think this one had already rocketed to the upside. Yeah, we looked at this one last week and said that if you hadn't gotten out, you were getting greedy, and that turned out to be prophetic, right? This is why I talk about I don't like things that go vertical. When things go vertically up, they have harder corrections back to the downside. So the entry here was on the 13th, right there, and it already looked like, geez, we got a gap, but it's an ADR. So when you have an ADR, American Depository Receipt, which basically means it's a method of trading a foreign stock on the U.S. stock exchange. So what an ADR is, you're going to get gaps because it's subject to what happens in overnight trading in the foreign market that it's trading in. So we had closed at 29.14, and then we went all the way up to 31.54. It's a pretty good move to the upside. Now, if you're still there, it's still above where we got in, but you're looking for a continued move higher. Well, we're now below the 10-day moving average. And so that's a little less desirable. And you can see after the ADX got above 40, it's moving back down. Technically, it's still between the two directional indicators, but that's not what you want your ADX looking like. So you have the ADX curling down. You have the positive directional indicator curling down. Even though the ADX is between the two directional indicators, that's not the scenario. So this is one of those don't get greedy type of scenarios. And then SAP we also looked at the same day. And look what happened today there. So going back to the 13th, we were at 134. Well, you know, again, when do you want to get out of those? So if you didn't take that profit, then that is getting greedy, because we were 144. So that was a 10-point move that happened in a very short period of time. And it's another lesson of, if you didn't take your profits, if you're getting greedy for a continued move higher, then this is what can happen to you, unless you put a very tight stop. If you did that, then it's okay. But I'm not a favor of putting on actual formal stops, because market makers can see them. There's a lot of information out there on the internet about that now. We talked about it for a long period of time, as far as when you put on a trailing stop, market makers can see it, and they'll figure a way, by the way they process orders, to manipulate the price in order to hit stops. They can do that. So the only way to do stops where you don't risk that is to do them mentally. And then sometimes you're like, you know, it's moving down. I said I would get out, but I'm not going to. I'm going to wait. So it brings the emotional aspect back in when you try to do mental stops. But the physical stops, the actual ones, pretty much a guarantee you're going to get stopped out. So two good lessons there, that if you didn't take those gains, then you probably got a bit on the greedy side. Let's see what Cree did. This was another strangle that we looked at on the 20th. And you can see we had already a downward day. And then as we move forward, came back up. So perfect example of why we need a second day, follow through a confirmation day. So that first day was a head fake. The next day we moved back up. We got within the window of the triangle. Following day, we were fully within the window of the triangle. Now it looks like you're going to break to the upside. Do we get a follow through to the upside? We do, but then we came back down. So our subscribers ask us a lot on when to take off one leg of the option. And this is a good educational example that if you go to take one of those legs off too soon, this can happen. So if we counted this day, and I would have, as a breakout day, and then we get the follow through day, it looks like we're breaking higher. So there would have been a temptation to, like, okay, let's take the put off and just let the call run, because when you do that, then you have an opportunity to generate a greater gain than that 30 to 70% that the strangles normally form. So the question gets asked a lot, when is it okay to take one leg off? You don't want to take one leg off until the position is at least a break even. In other words, one of the directional moves has made enough. In this case, we're talking about an upside breakout. So the call would have made enough in order to recover the cost. And the worst thing that can happen is that you break even. So if the stock does reverse like this, like, okay, well, it was a break even trade. I tried to make a little bit more. It didn't work out. I ended up at break even. So a good example of why you don't want to start to take off that other leg too soon, because look what ended up happening with it. It made a big significant move to the downside. So here we're all the way up here. and you're thinking of taking off the put when you're at 119, well, now we traded as low today as 90, closing at 94. Significantly lower than where we were. So this was likely an earnings report day, I would imagine. But still, the educational part of that still holds true. Even if you get a breakout and a follow-through day, don't be so quick to take that other leg off. Things like this happen in the market all the time. This is why we do strangles, so you cover both sides of the position. So this one gave us this false breakout to the upside, a confirmed break, or false breakout to the downside, a confirmed breakout to the upside, and still reversed and went back lower. And if this was the earnings report day, which again I assume it was, you wouldn't have been very smart to take one of the legs off anyway going into earnings, and that probably wasn't enough to readjust the deltas. So this one would have worked out okay if you'd just been, all right, there's an earnings report in a day or two, I'm just going to hang on. So you probably would have been okay. But don't get greedy going into the earnings report is the long lesson. So let's take a look. We had a watch list on Dollar General to see if we were going to break above 220. And you can see we still haven't. So this is why we look at support resistance. It matters. So the stock ran up. We looked at this a while ago and came back down. Looks like we're heading back up. We fell down today. Not a bad day, though, considering where it opened and when it closed. Maybe we turn around and head back up, but it still holds true that you look for this one to break above 220 before you consider it. But if it does, well, it's got a lot of clean air above it. It could really run all the shorts that have been stepping in there and there and there. In there, all those shorts would have to cover, and then you could get a pretty significant move to the upside and likely some buying coming in as well. So it wouldn't just have to be short covering to generate a gain on a move higher. But that still stays on the watch list that it has to break above 220. All right, so with where we are today, let's see on our searches, and this is included with Profitsource. There's some search parameters over here. Wow, even on a down day, there's 12 results on our momentum scan. That surprises me a lot. So the momentum scan is lower dollar stocks. Our subscribers were asking questions a lot about all the Reddit, Robinhood stocks, and they were asking for symbols that I wasn't familiar with, and I wasn't familiar with all that stuff that was going on there. And I'm like, where are we getting these stock symbols from? And then when I did some research and figured out what was going on, I said, okay, well, if you want to dabble in that space, let's try to put a little more technical analysis behind them. So we created this search. And we had some success with it going back on the 30th. If you look at BAK and CBD and some of the other ones that we had that did very well. But I'm just surprised with the way the market acted today that there's that many results. Then you can see here there's EWO, bullish, corrective, impulse, consolidating. Those are all my own search parameters that I've developed over time that the folks at Hub have been kind enough to include. If you're an Elliott Wave option alert subscriber and you have Profitsource, they include those searches in there. So you can see basically exactly what I'm looking at every single day. Now, when you come here and look at the impulse search, which is the bullish one, there's only 4 results. So there's 4 results on the impulse, but there's 12 on the momentum. Is that an indication that the market is rotating back to small caps? Some of our momentum alerts that we have right now did pretty well today. So maybe that's a sign. Now, if that's true, wouldn't that be a catalyst to move the market higher? And I think it would. A lot of people look at the small caps to say, okay, do we have, some significant momentum, hence the name momentum scan, to move the market higher? So let's take a look at them. So there's 12 of them. So just out of curiosity, we can come up here and we can also click on bullish wave 3. So we can see if any of these 12, rather than going through 12 charts, are in the wave 3, and there's 1 designer brands. So now we just narrowed down 12 potential charts to 1. We can take a look at that real quick and see if that's something that we might be interested in. And it does look pretty interesting. We usually take the rest of this stuff off and then leave the DMI because it's my favorite of the confirming indicators. Now, one thing that, I mean, that's a pretty easy move. We got a zigzag right there, looks like, right here. So we got a pretty good target price up there at 21, and that happens to be exactly the lower end of the tap box, which is the wave 5 projection. So you've got a couple different Elliott Wave patterns here giving you 21 to 23 as a price target. So that's always a positive to see that. And the ADX is moving up, which is good. It's between the 2 directional indicators is good. The negative, though, is the stock finished to the upside today, but the positive directional indicator went down. Would have liked to see that move to the upside. So that's a negative, but it's the only negative that I see. We look at the 10-day moving average, so we're good there. Tapped it on the low and moved higher. So that one doesn't look bad. So I'm going to make a note of that. We'll take a look at DBI. See where that goes from here. And now let's go back. See if there's anything. See what happens here is with these momentum ones, I don't know these symbols because they're all lower dollar stocks. And for the majority of my trading career, one of the filters that I've had in there is I don't want to look at anything under $20 a share because that's where the big institutions are. So when you're starting to look at these lower dollar stock, I don't know any of the symbols. So I'm just looking at patterns and trying to be as specific as possible on patterns. So there's bonds, Angel Oak Financial. Let's take a look at that one. Voya Industrial Materials. Let's actually look at that one too. Just because of the space that it's in. Yeah, that's a okay. Now the positive directional indicator ticked down today, but the stock did too. So that's understandable. It had gotten just a touch above the 10-day moving average yesterday, so it came back down. So that's a lot different when the positive directional indicator ticks down on a down day versus ticking down on an up day. When we take that off, and you can clearly see where the impulse started here. I don't know if that's enough of an impulse there to enough of a correction. Yeah, I don't think that's something to be too excited about from that standpoint. But it doesn't look like a bad pattern. It just doesn't have a lot of room to move. We're 1248, 13. I think we'll pass on that one and look for something else. New home. Yeah, there's another doji. They're everywhere. Now look at that DMI. That looks pretty darn good, doesn't it? Got the ADX moving to the upside. Now here we have a day. It did finish to the upside, even though not the kind of exact day that you want with that more of a gravestone doji. But you look at the 10-day moving average, and on the high for a lower dollar stock, $6 stock, that was too much separation. So that's why that came back down. It does look like it wants to go higher, but we're going from 660 to 750 maybe. It's less than $1 move. I don't know that I mean the DMI looks great. So curious as to where that goes, but I don't know that that's something that we want to be involved in. Healthcare. This would go on the watch list Because look at that, the ADX came back down. It got down to 20 and didn't quite get below it. Would have preferred this ADX to break 20 and move higher. But the ADX is the positive directional indicator is trying to move back to the upside. It would have to get on the other side of the ADX to continue to move up. So we'll leave that one. And then we'll look at one more, and then I want to look at see if we can find a strangle. But the DBI so far is something that we would potentially put down as one of today's alerts. And community bankers, let's see what that one looks like. Another financial. Now, the reason that the financials had a little bit of a tick up today is Janet Yellen came out and talked about interest rates might need to go up. And we've talked about this with financials in the past, that financials make money based on the spread, right? So you look at the 2s and 10s is what you normally hear. Rick Santelli on CNBC talks about it all the time. You have to remember, banks borrow on short term, the short end, and they lend on the longer term. So they make the difference in the spread, right? So the idea is that they're borrowing at a lower rate, shorter term, lending on a longer term, and lending at a higher rate. That's one of the ways that they make money. And so if interest rates go up, usually the spread widens and it allows them to make more money. Now, when we look at this, see, this has to go on the watch list, but this looks really interesting. The reason I say that is the ADX is curling up, but it hasn't gotten to 20 yet. And that's one of my rules. The ADX has to get to 20. You look at the separation here and you're like, but look how good that looks. And it does look good. Separation between the two directional indicators, the ADX is curling up. But there's too many times then the ADX comes up and it gets towards 20 and then it goes back down. So one of the rules is got to break 20. So we just have to hold off. But that's going to go on the watch list. Because that if that ADX does break up, then that looks pretty darn good. All right, so let's our designer brands, DBI. Now let's see if we can find another strangle where we look at the consolidating stocks, see if they're in a wave 3, and there are some. Right, let's see if we can't find something in here. Caterpillar, I think, is likely already broken. No, it hasn't. Look at the oscillator. Look how far down that's come. That's another indication of the slowing momentum. So we do have an educational series on the website called TradeScan, which shows all of our indicators that we look at and how they work. So I encourage you, if you haven't already, to go through and look at those. We've got a set of confirming indicators that follow along. So don't really see, that's just kind of going sideways, not really a triangle pattern there. So let's look at something else. Southwest, it's been on the search before. And this one makes sense because of the dichotomy that airlines are in right now, where people are starting to fly again. They're going to start increasing capacity so they can fly more people. But now fuel costs have gone up. I do know that Southwest hedges, though. We've talked about that before. So this is very similar to when we looked at pre-research, where you've got a breakout day to the downside. Remember, that doesn't mean anything. So you could still go ahead and enter this one if you wanted to. So let's make a note of that. For Strangle, we'll look at a couple more and then we'll take a few questions. United Rental. The first thing I look at is to see if there's some that show up often, because there are stocks that consolidate, break out, consolidate, and break out. And that's just kind of what they do. This is 320, so this would have to be in our high value portfolio, which is for those that would be interested in positions that are more than our normal $500 max risk per alert that's sent out. So looking at that, it's not a bad looking triangle. I just don't know that it's wide enough. 3 to 340, it's borderline. Might be kind of expensive. We'll put that one on the watch list too. And we'll look at that Woodward as well. Maybe even Signet Jewelers. Yeah, this one's sideways, so forget that. That's the exact opposite of what we want. And that's what this search will find. It doesn't always find triangles. It finds consolidating stocks. So some of them are in triangles and some of them are just going sideways. So as soon as you see it going sideways, you just discard it and move on. Well, I'm glad we looked at this one. This might be the best one we've seen. Look at that. There we go. All right, so that's an official one too. So Love was borderline, but this one's good. So SIG. So we've got directional and non-directional, I think makes a lot of sense given where the market is right now. And again, the futures are up, so we'll see if they close in the morning. So with that, I'll go ahead and take a few questions. If Zach, if you're there, there's a few questions that people have sent on stocks they might like to look at. Normally there are.
Rob, yep, there's a number of questions, but I know we're one after the hour now, so just take a couple or however many you like. You can start out with.
Yeah, I'll take a few. I got started a couple minutes late, so I'll run a couple minutes extra. So yeah, let's go through them as quick as we can. Just fire them away.
Sounds good. We'll start out with Charlie. He said QQQ seems to have reached the top. Please cover UAL as well.
Well, we do have the SQQQ, which makes money as the Qs go down. So that's obviously had a good day today with that movement. And that's a little different look than, that's pretty interesting, isn't it? So we talk about this. I think this goes to the indecision that exists in the market right now. So the S&P did gap down, but then it closed near the high. So it recovered well off of the lows. Still could have a big down day tomorrow, but we'll have to wait and see. But the Qs, different story. Qs opened higher and closed much lower than where the open was. So that's flies in the face of what the market did. There were some people in the financial networks today talking about that they felt technology was going to lead the next leg higher. Doesn't look like it from that day, does it? Again, one day doesn't mean a thing. Everything could be totally different tomorrow. So we have to wait and see what that looks like tomorrow. But as far as in today's trade, yeah, that's not what you look for as far as, hey, this sector is getting ready to lead the market. Now, it may be a bit oversold. We look at the 10-day moving average, and it is. It broke below the 50-day, which is the royal blue line, closed back above it. But the gap down tomorrow, you know, if we go to the upside tomorrow, we have to be careful that it's not just gap filling. It would need to recover the 10-day moving average on both the Qs and the SPY. So United, well, let's see if that one has a triangle pattern like Love does. Normally the airlines look pretty similar, and yeah, this one does, because you have a pretty significant set of lower highs there. Maybe not quite as good on the low side as far as higher lows, but a little bit of a breakdown there. See where the ADX isn't quite low enough for my liking there, but definitely indecision here on United. And I talk about this all the time. This is a great chart to bring it up. Triangles are a big part of what we do, because the volatility portfolio is vast majority strangles on triangle patterns. That's what we're looking for. We're not picking a direction. We're just taking advantage of a movement that moves either direction. And so we don't end up picking one either way. So then when we see triangles, Elliott would say, well, if you have a triangle in an impulse pattern, the breakout is still likely to be in the direction of the impulse. My viewpoint from a trader standpoint is that if you have a really good triangle, you still want to protect both sides. Yeah, it might break in the direction of the impulse, and we limited our potential return by putting the strangle on, but nothing is 100%. And that way, if you put a strangle on it and it breaks out, well, then you have both sides covered. But Elliott himself says when you have a triangle following a wave 5, now that's where you put on the strangle, because this could break either direction. So even he would agree that some sort of a strangle would be prudent here. Now, the interesting thing about this one is the width of the mouth of the triangle is better than LUV, but the ADX isn't as low. So that's kind of a toss of a coin. What does that mean if the ADX isn't as low as normal? Does it mean that it can't break out? Absolutely not. So I want to be very clear about that. I like the low ADX because normally when the ADX gets very low, it's showing you this stock is about to break out. But when the ADX is higher, it can still go down. So even though you see this and it looks like a great triangle pattern, sometimes even a good looking pattern will go sideways for a while. And that's the last thing we want, right? With a triangle, happens sometimes. They don't all move like, FSLY did that we looked at earlier. They don't all do that. It would be great if they did. If it goes sideways with a low ADX, and that's part of it. But if it goes sideways and you put it on when the ADX was higher, you kind of knew that that was a real possibility by doing that. So you take that aspect out if you stay with a low ADX. But you can go through and find tons of patterns where you had triangles and breakouts and the ADX wasn't down below 15 or 13, which are the levels that I look at. So there's no guarantee either way. This could break down significantly tomorrow, or it could be a head fake and break up, or it could go sideways. What makes this one worth considering is it's a pretty good, I mean, you can see tons of support right here, right? I mean, this is a major support area there at the bottom of the mouth of the triangle at 45. You're all the way up at 65 at the top. So that's 20 points. That's a lot. That would definitely be worth a consideration. No doubt about it. Even though the ADX isn't as low as I would like, when you got a $55 stock with a 20-point mouth in the triangle, yeah, definitely worth the consideration. All right, sorry, I said go quick and then I talked too long. Next.
Baron would like to look at AMRC and AMBA.
Guys are figuring out that if they get their name called, they can get more than one in. We might have to start doing a one symbol limit here. Amoresco. Pretty nice ascending triangle. Bottom is at 40, 50. It's not that wide of a triangle, and it's consolidating coming off the big drop. Move to the downside today. You would want to watch for that one. I don't know that I would do a strangle on this one. I don't think the mouth is wide enough, but I would look to see if you got follow-up through to the downside. And if you did, you might look from the short side. It's got a 5-wave Elliott wave pattern to the upside with a really solid wave forward, a 60% correction. So I'd be on the lookout for this one giving a one-day head fake and possibly turning back to the upside. As much as the market is going to be really interesting to see what happens tomorrow, this one will be too. So if you're trading this one, yeah, I would be on high alert to see what happens tomorrow. All the major moving averages have converged here, so it does show consolidation. It's just the mouth of the triangle isn't quite that wide. So yeah, that's what I would look for. I'm sorry, I forgot the other symbol. What was the other one? We had AMRC, and what was the other one?
AMBA.
Likes the M stocks, huh? Well, these are good triangle patterns. So is it Baron? Is that who asked these? Those are good looking triangle patterns. So this one is interesting as far as I drew the line there for support. You could easily make a case for drawing it back here. And it is another level of support. Why did I draw it where I did? I like to draw the support line where there's more touches of the line. Clearly that was support resistance going back to December, tested it a bit here in January. But you can see that boom, boom, boom. There were more touches of the line there around 95 than 90. But this breakdown here, it needs to break 90 too. But this one, a whole lot different because that's a big mouth of the triangle. So depending on what the options look like, I'm actually going to put that one on the watch list as well. Take a look and do some options analysis on that one tomorrow, because that one looks like that could really run. So the bottom line here, just to be clear, I don't count this as a breakout yet, even though you could say, oh, well, it broke down and it confirmed. There's another layer of support here. So I just wouldn't count that yet. I would want to see a break of 90. And if it does, you got plenty of room because you're coming all the way down here to 60 at least to the downside. I really like this one. So that's a good spot. See the ADX, really good looking one. So good job on this one. Yeah, I like that one a lot. All right, next.
Right. Pankaj said, can you please cover Roku? I am holding 300 put in Roku.
Good job, Pankaj. Well, here's what you want to watch for. Just be careful at 300. It's probably coming down to 300. I mean, you got a zigzag right there. So look at that. You're at the 100% extension today. Wow. I can't imagine it's going to stop here without not coming down to test 300. But watch that, Pankaj. Watch the 300 level there. If it breaks that, you got a grand slam, because if it breaks that, it's coming down here. But they're going to try to protect it here. So there's a lot of institutions that own this stock, and they're going to step in and they're going to try to hold that line at 300. So I don't know how much profit that you have in your position with this downward move. I would put tight stops. You can always re-get back in if it breaks 300, because now you're going to 220. So there's another 80 points. So I would be, wanting to protect that, the gain. It's also a little bit oversold. So there's a couple different things that are saying that it may have a little bit of a bounce here soon. I don't think it's going to be long-lived. And I'd keep an eye on the 300 level. So yeah, I see why you wanted to ask. You're at a pretty good point of trying to make a decision here. A great job on putting the trade on. Next.
All right, so there's a couple questions on just the general market. First is from Jesse saying, does the ADX apply to SBY? And in addition, Pankaj said Tom Lee is saying that the next target is 440 for SBY. Is there a possibility for 440?
Yeah. I listen to Tom Lee a lot. I don't always agree with him, but he's been around a long time. There's only a handful of guys that when they speak, I turn the volume back up. I think you've heard me joke before that I have CNBC on, but with the volume off, because there's just so much. There's just so many ulterior motives out there that. But anyway, 440 is still a possibility. Remember, we still have this other zigzag target here, where we could go up towards that 425, 426 area. The big zigzag takes precedent, which was 420. So I would look for the 425, 426 if we move higher to be another point of resistance, but 440, 460 have been talked about as well. We're above 400. We hit our target of 420. be careful on the long stuff from here. In our alert portfolio, some of our momentum stocks have earnings this week, and we'll see how that goes. We had some great earnings last week, but we didn't get any follow through on fantastic earnings reports. All those are signs to be a bit cautious. But yeah, I mean, 425, 426 could happen. I've heard the 440 level. I think Tom Lee's been saying that for quite a while. And then the 261.8 gets all the way up there around 460. But we got to get back above the 10-day moving average and break above 420 first. If we do, then we start looking for new extended targets. But the fact that I haven't seen that many times when the market goes to suit 261, that it makes me super cautious. Was there something else on the market, or?
Just Jesse's question of, does the ADX apply to the SPY?
Oh yeah, sorry about that. Yes. So the indicators that I look at are very complementary to Elliott Wave. That's one of the cool things that you can do with Profitsource is you can run tests. And I used to do this every single night because you can pick years. You can run it for since the beginning of time, which would take you forever, or you could pick a block of 10 years. What I used to do is give like dynamics of, if you hit a 50% gain, take the profit, whatever, because you can program those things in. But I would run searches. I would set the search up, go to bed, let the search run all night, wake up the next day and see what the results were. What were the percentages of accuracy? What would the profit have been? Is it worth it? And then tweak it and change it, and did that night after night after night for a very long time till I created the system that I use now. And so my point is, the indicators that I look at are complementary to Elliott Wave, and Elliott Wave works better the more liquid the issue is, because Elliott's desire was to try to mathematically predict the behavior of the masses based on their past behavior, feeling like fear and greed don't change. Doesn't matter what generation you are, fear and greed are our two primary emotions. So it doesn't matter if it was 50, 60 years ago or right now. It's still the same. The emotions are still the same. And so the more liquid an issue is, and I think that would be pretty universal with Elliott watchers and traders, that the more liquid, the more accurate. So when I'm looking for confirming indicators, I want those that have those same attributes, that liquidity is a good thing. So since the SPY is the most liquid issue that's traded, yes, it does work with the market itself. It has a lot to do with it. If you want to see where it is right now, you can see that it had a little tick to the downside today. This is not what we want to see. If that negative directional, well, if you're long, if that negative directional indicator crosses above the positive, quite often they come together and they kiss and they go back apart though. And that's the thing. People will look at that and say, in the next day or two, that negative directional indicator is going to take control and it's going to show you the shorts are now in control. It looks like that now, but they have to actually cross. Don't make that assumption, because they'll come, they'll kiss, and they'll go back the other way. So, but yeah, the ADX works, and it works in short time frames too. I watch the market on 3-day charts, whether I'm looking at the futures market or individual stocks. I'm looking at 3-day charts, and I have the DMI and the CCI up on those charts all day long. So that's the answer there. Let's take one or two more if they have, and then we'll wrap things up for tonight.
Alrighty, so we have one from Brian. You already covered the QQQ, but he said, is it wise to hold leverage short ETFs for a few days, SQQQ, SPXU, and SRTY?
Yeah, so let's just look at the SQQQ since we have that one. They're all roughly in the same type of boat. And you can see this is back where we got in here in this area. So it's gone down, but we kept it on because the market has been squirrely for quite a while, and then you get one of these days. And so you can see this wasn't an ugly day in the market. So if the market gets ugly, this can rocket back to the upside quick. In fact, speaking of rocket, doesn't that look a little bit like the launch pad effect? Those of you that are new may not know what I'm talking about, but our longtime viewers and subscribers know what I'm talking about. So we have a sideways consolidation here, and then there's the blast off. So is that going to continue tomorrow? It might. We'll have to wait and see how that plays out. But yeah, I think it makes sense unless we break. If we break above 420 and we confirm that move, then we will look to do some different things with our downside protection, because we've got a pretty substantial move higher if that occurs. But we're a long way from that happening yet. So yeah, I still think it makes sense to hold those. Now, you might note that where we are on the high today is a tiny bit of resistance. So if it does break back to the upside here, I mean, it could be off and running. It really could. So let's see how that plays out. All right, one more, and then we'll call it a night.
All right, well, this one's from a different Brian, and he said made 115% on a GPS 521.21.30C, closed out on 503. Question I have is, did I get out too soon?
Congratulations on your profit. And without even looking at the chart, I would say no, because if you closed it out, you were happy with the profit when you took it off. Don't second guess yourself. You'll drive yourself insane. It's the quickest way to blow yourself out is second guessing yourself. I've always said that when you take a position off, if you were happy with the gain, then be happy with it. There's nothing wrong with going back and looking at it to learn, and maybe you take that information in the next time you have a decision. But as far as this one, no. What was the symbol?
Not sure there was a symbol included. He said made 115% on a GPS 30 call 521.21, closed out on May 3rd.
I think, was it GPS was the symbol then? Yeah. There's a nice zigzag there. Let's see. So we'll start from here with the doji or the impulse move. Perfect, 50% correction. Well, you hit a major fib level. So if you were happy with the profit then, now the zigzag and Fibonacci rules would say that it's probably going to 39. So from that standpoint, you could have looked at holding it a little bit longer, but you were in a major fib level. It tried to break above it yesterday in a big way. Still had a nice gain. Sideways day today. It could hit 39. That's a very, very nice looking zigzag pattern. In fact, they don't really set up much better than that. The DMI is supportive. So from that standpoint, could you have held it a bit longer? You could have, but I still encourage you, don't second guess yourself. You were happy with the gain. You made a nice trade, great looking chart. So congratulations on all aspects of those. Maybe look to incorporate the zigzags and the DMI, etc. So my point, when you get to a fib level, a major one, 61.9, with a 50% B wave correction, you're looking for 100% extension. Obviously, you have to be nervous when you hit a fib level. So then we take a look at the DMI to see, is it supportive of moving to the next fib level? In this case, it is. So from that standpoint, I would say, maybe you could have looked to see it there, but don't second guess yourself. So thanks, everybody. Appreciate your participation. Always appreciate your time. Time is valuable for everybody. Have a great week, and keep an eye on what happens tomorrow. So I've given you the parameters to look for on whether we get a follow through the downside or we turn around. Today was a head fake. Have a great week. Talk to you next week. Take care, everybody.